Hello, my friends! It's your friend Anna coming to you with my beautiful friend Susanna from New York. Hello. What are we doing today? We are going to talk about money, but more importantly, we're going to talk about 10 ways rich people avoid paying taxes. So as you know, it's tax season now. This year, taxes are due on April 18th. Unless you file an extension, then you can go all the way to October 15th. But otherwise, even when you're filing an extension, you still have to pay your estimated tax payments. So how do wealthy people who can hire professionals like me, I'm a financial consultant, I'm a financial planner, and other professionals such as your attorneys and accountants and so on, how do they reduce their taxes legally? There are many ways to do that. So we're going to talk about that, my friend. And FYI, Susanna here is my student. She's learning. So if I ask her questions and she doesn't answer, don't worry. Okay? She's one of the students. And we're just going to just talk about some interesting stuff. Okay, so hopefully we can make this topic of taxation and money a little bit more fun. Right?
Okay.
I know, yeah. Some people don't like
I don't like talking about taxes.
Okay. All right, so let's start with point number 1 that I wrote for you guys is first thing is so avoiding taxes and avoid paying taxes. Um, One way to sort of reduce your taxes is starting a business, by starting a business. So in our I'm in the United States, so we're talking about the United States taxes, obviously, because we have friends and people that listen to our programs from around the world. So this is talking about the United States, guys. But it probably is similar in other countries as well, especially Western European countries or even Eastern European countries. But at least in the US, when you have a business, that's a source of huge tax items that you can deduct from your taxation. So basically, the way the business operates is anything and everything that you spend toward running the business is considered an expense, and that's deductible.
So everything business related, you can.
So you're running let's just say any business that you like. Tell me a business that you like.
Okay, let's think of like a consulting business, maybe.
Okay, consulting business or running a restaurant, it doesn't really matter. Let's just say running a restaurant. Okay.
Let's pick
So you have a rent for the building. Then you have waiters and waitresses. Wages. And then you have food. Then you have, let's say, advertising costs and PR, insurance, maintenance. All those things are reduction of cost, repair. So even for those people who, let's say, are working for a large corporation, and again, not everybody has to run a restaurant, but like you said, you can have a side job, like a consulting business, and you can reduce your income taxes just by having those expenses being deductible for you. So, running a business is a really good way to legally reduce. Charlie's not happy about that. Yes, Charlie, you don't agree with me? Do you want to say something else? Tell me. What is it? What is it?
He says he doesn't want to pay taxes.
Oh, okay. No one wants to pay taxes, but we have to. Somewhere with little or no tax. Okay, so that's another one. It's very interesting to rich people who avoid taxes. Okay, so if you live in the US, there are some states such as Florida or Nevada or some other states that do not have state income taxes.
I think New Hampshire is another one, right?
Yeah, there are some other ones as well. So there are some states that have lower income taxes, like state income taxes. and there are other states who have no state income tax. So that's one way to reduce your taxation is by moving to a state where they don't have a state income tax. So that's gonna obviously help you with that. In fact, I know a lot of New Yorkers who are moving to Florida because of that. You know, especially after COVID, when everything has become more virtual, people can work from anywhere. This has become much more apparent. Um, and I heard a number, something like 1,000 people a day are moving to Florida right now.
Actually, yes. I personally know a few people who moved to Florida.
Me too.
Because, like you said, they work from home, so their location doesn't matter. And then if they can enjoy the weather,
that's right,
and not pay taxes, why not?
The income tax,
state
income tax.
Yes.
So that's one way. Charitable donations. Let's talk about charitable donations. So the income tax code here in the US is such where if you make a charitable donation to a nonprofit organization or a foundation or any charity, then that is 100% tax deductible from your income tax. So oftentimes people are very passionate about different charities or different causes, and it's basically, look at it this way: if you make a charitable donation, you're going to reduce your income tax bracket, for example, sometimes. So you're going to reduce the percentage of taxes that you're going to be assessed on. So if you make no charitable donation at all, you make certain amount of, you pay tax. And then if you, by making a small or some charitable donation, you're not only helping that charity, but also you're reducing your taxation. So I just think it's a win-win situation. I really do.
So let's say instead of paying like 20% taxes, you might end up paying maybe like 18 or 15%.
Exactly. Oh, it's another one. So the rich people, the way they reduce their taxes is instead of taking a salary, they take equity.
So how does that work?
So equity is taxed completely differently than taking a salary. When you take salary, it's taxed is based on your income tax bracket, and when you take an equity, the formula and the way it's taxed is absolutely different. And not everybody has the opportunity to do that. Obviously, it's usually more for high-end people who are, you know, either executives of a firm or decision makers and so on. But definitely that's one way to consider about reducing your taxes, because it's almost like having a C corporation where you can make a decision if you want to keep your profits in the company or you want to distribute. So it gives you like more of a.
So that means like if let's say you're a CEO or some kind of an executive, instead of taking your full salary, you can choose to invest in your own company. Is that what you mean by equity?
No, if you are a let's say if you're working for a public corporation or a public company, and instead of taking salary of, I don't know, $500,000, you take stock options. The next way to think about avoiding your taxes, or not avoiding it, but reducing it, to become a nomad. You know what a nomad is? Okay. So basically, a nomad is when you don't really have a permanent residence, right? And the numbers of nomads are growing actually, and reality is, I would love to be a nomad. If I didn't have young kids, I would definitely be a nomad, which means you spend 3 months in, I don't know.
Alaska.
No, why Alaska? Well, Alaska is beautiful, but let's just say we spend 3 months in the Caribbean, and then we spend 3 months in Europe, and then we spend 3 months in some other destination. So we just constantly are moving. So we don't have a permanent residency status in one place. And as a result, you don't have to pay taxes. So unfortunately for U.S. citizens, as long as a U.S. citizen or a U.S. resident, it doesn't matter if you live in the U.S. or not. You still have to pay taxes. So this doesn't apply to U.S.
I thought it was if you live at least 6 months in U.S.
You always have to file a U.S. income tax return, and there is a cap. I believe last time I checked, it was $140,000. If you're making less than 100 or so thousand a year, then you don't have to pay taxes to the U.S. government if you're making more than you do. But everyone has to file a tax return. Whether you earn the income here in the U.S. or not doesn't matter. If you're a U.S. citizen or a U.S. resident, permanent resident, whether you live here or not, you still have to file a U.S. income tax. But by having many residences and not having one permanent place, you're avoiding income taxes on a country of residence that you would be claiming, right? And there are many countries who don't have non-resident income tax, meaning, for example, Georgia has this. Their tax law is very favorable to people who are outsiders, because you can live in Georgia full time, but as long as you're not making the money in Georgia, then you don't have to pay tax to the government of Georgia.
Oh, so you can
As
just
opposed
leave
to
there.
Armenian government, which doesn't have. Hopefully, at some point they change their rules. But for Armenian government, if you're living there for more than 6 months, then regardless of where your income is made, you have to pay income taxes to the Armenian government. So you would never want to you would never want to be a full-time Armenian resident, because if you have income coming from other countries, why would you want to pay taxes unless you want to? That's another But if you don't want to, then you have to think of that. But yes, becoming a nomad and having different residences in different countries will basically avoid you paying income taxes to one country of residence, because you don't have a country of residence. Because typically, to have a country of residence is you have to live there for a period of time, and it typically usually is 6 months or more. Okay. Any questions, my beautiful student?
No, it's clear.
It's clear.
I gotta just keep moving.
Constantly are moving, so we don't have a permanent residency status in one place, and as a result, you don't have to pay taxes
Country to country.
Listen, imagine if we had 3 places. I'm thinking, like, for example, we could have a beautiful place in Greece, for example, Greece or Bulgaria, nice summer residence in Greece or Bulgaria on the Black Sea.
Ooh, okay.
Same with Canada.
Mexico?
You're okay with Mexico.
Okay. Then we go to Mexico.
You want to avoid US, Canada, Australia, and UK.
Okay.
Those you want to avoid. They're like,
okay.
You're our citizen? Pay. Don't you even think about not paying. Although the rules are different.
I'm sure they are.
They're a little bit different. It's like Canadian and UK is a little bit. The worst one is the United States, believe me. The worst one is United States. In fact, when you're a US resident, first 8 years, you can still give up your US residency and they'll let you go. After 8 years, if you decide you want to give up your US residency, or if you wanted to give up your US citizenship, they're gonna tax you as if you were dead. I'm serious.
They're gonna tax you as you're dead?
Yeah, as if you were dead. So they're gonna tax your estate.
Oh, your estate, if you have an estate.
As if you were dead, yeah.
But what if you don't have an estate?
That's different. Then if you don't have an estate, why would you give up US residency? Most people give up US residency or citizenship because they have a lot of money and they don't want to pay.
I see.
I have other stories. In fact, I have a lot of clients, let's say from Brazil or some other South American countries, very wealthy, and they come to Miami to party, and they have children purposely here in the US so that the kids will be US citizens without realizing what this means, because the child that is born on the US soil is automatically a US citizen.
That's true.
And when this child grows and inherits those billions of dollars, then the family business is subject to US income taxation.
And inheritance tax too.
All that. Yeah. So be aware. All right, so next, how else can we reduce our taxes? Let's see. You have no money, but you have assets you can borrow against. Oh, pay. So you can borrow against your real estate, you can borrow against your life
equity loan.
insurance, all that. Yeah. That makes sense, because when you borrow money against yourself, you're paying interest to yourself, like a life insurance loan from your life insurance policy. Claiming your yacht as your second home.
I heard of that.
What did you hear?
So one time I met a client
Uh-huh.
when we used to own a bar, and he was saying that he lives on his boat, and I was like, what do you mean? So he said that he has a big yacht and they made it just like their own residence, and he's like, oh, guess what, we're not paying like taxes, so much taxes for our home, and it's not costing us as much to live on it, and as long as they park it at whatever they can park the yachts at, and it costs them a lot less than if they had their house, because he was like, our kids are already grown up, it's just me and my wife. First his wife was against it, but then she kind of accepted it.
So they're living on a yacht. Interesting.
Yeah, because he said they have everything. They have a kitchen, they have a bedroom, they have their shower, you know. And when you get used to it, it becomes your home.
Did you hear about like those big like boats that like are residences that you can go actually live on them or something like that? How do you like our Armenian wine?
It's
From
wonderful.
Artsakh. It's good, isn't it?
Wonderful wine.
Yes. Excellent. All right, so moving on.
Okay.
So if you have a yacht, you can claim it as second residency, and you will reduce your taxes because you're going to pay less taxes. Using a trust to avoid paying estate taxes. Yes, this is a big one. There are many different trusts that you can set up. You're basically making a gift to the trust, and then your heirs can use the trust or the income from the trust when you're basically passed away. So there's two ways. You can either give the income to the nonprofit while you're living, and then proceeds, the rest goes to your heirs, income tax free and estate tax free. That's one way. Or you can make small contributions to a trust where it's set up where your heirs get the trust distribution income on estate tax free upon your death. So
it's always upon your death?
It's usually always upon your death.
So it's not like you can set up a trust and say when my children reach like age of like 25 or something, they can tap into that trust.
You can set up a trust that when they reach age of 25, they can tap into the trust. Yes, you can do
but
that.
That's not, you're not avoiding taxes that way.
Well, typically you wanna you just, because as long as you're alive, you can control the money, right? So typically trusts are set up to function and sort of get turned on after your death.
Oh, I see. Okay.
Yeah. Depreciating assets on paper to outweigh the cash income. That's another way to do that, because depreciating assets on paper. So for example, people can set up, for example, family limited partnerships. And let's say parents can be the general partners and the kids can be the limited partners. And because it's a family limited partnership, and let's say you transfer the business into the family limited partnership, then because it's not readily sellable, the price goes down because of it. So you can reduce the price of the business just because it's in a family limited partnership and it's not sellable. It's not as easily sellable. So say if something is worth, I don't know, $1 million or $10 million, you can reduce the value of it from 10 million to 8 million, just because it's not like a stock that you can sell on the open market. You see, it's a small business, for example. And you can gift portions of this family limited partnership from the general partners to the limited partners on a yearly basis, but at a lower price point because it's not sellable.
I see.
So you're transferring assets to your next generation but at a lower cost, at a lower valuation, because it's inside of a limited partnership, which is not as easily. You can't sell a limited partnership. It's not like you can stock. I can go online and sell the stock in 5 seconds.
Right.
Limited partnership, you can't, because of that, because of its liquidity issues. The value is reduced typically sometimes as high as 30%.
Oh wow.
So that's another tax estate planning technique actually, and tax reduction technique. And also buying art. Let's talk about buying art and even diamonds, right? Over time, precious metals have appreciated in value.
Vous allez pas acheter cette croûte-là 30 000 euros? C'est pas possible, ça.
Ah bah si, c'est possible.
Mais le mec, il a saigné du nez sur un fond blanc, il demande 30 000 euros.
So buying beautiful diamond or precious metals now, or even buying art.
On s'intéresse à l'art.
Je sais pas, c'est un business.
Non.
Typically appreciates over time if you buy the right kind of art with the right kind of diamond. And you're putting this money here, and again, it's a really good way to invest in something that you don't have to pay taxes every year until you sell it, right? If you sell it.
Allez, arrêtez de dire n'importe quoi, donnez-moi un chocolat.
Non.
If you bought it for a certain amount and you pay and you sell it for a higher amount, then yes, you would have to pay taxes.
Okay, so let's say you bought a piece of art for like $500,000, and then you sell it for $1 million. So you have to pay the tax for the
Yes.
remaining VAT, like the difference, or
Yes, the difference.
the difference.
Those are the ways for our friends to think about reducing their taxes, assuming you're in the US. If you're outside of the US, there are many other ways to do it, but this applies to US residents and citizens. So hopefully this was interesting, and I'm sure there are similar rules and regulations in European countries and non-European countries as well. Any questions, please let us know. So happy to chit chat with you. You can reach us at getskillsacademy.com. Thank you very much, and we'll talk to you soon. Bye.
Bye.